Hi guys, this is Dan from the Investment ABC, and in this video I want to introduce you to another Chinese EV producer called BYD, which stands for Build Your Dream. BYD is the biggest Chinese EV car manufacturer and the second biggest one after Tesla in the world currently. Unlike Tesla or NIO, BYD seems to be the boring, unsexy cousin, but is currently operating profitably unlike the other two. The company was so boring that Charlie Munger and Warren Buffett got interested in it back in 2008 and bought 8.25% of the shares at a price of roughly $1. Currently, BYD is trading at $7.66, so Buffett's investment has been doing very well in the last decade. The question I want to discuss with you is whether BYD is still a good buy at the current price or not. Let's have a look first what exactly BYD is doing and if it has a moat compared to its rivals in the highly competitive auto industry. BYD was founded in 1994 and had its beginnings as a rechargeable battery maker. In 2003, BYD entered the auto industry and launched its first EV car, the E6, back in 2008, even before Tesla. Unlike Tesla and NIO, BYD is not a pure EV manufacturer. It also sells hybrid and fuel engine cars and many other commercial vehicles like EV buses and trucks around the globe. Furthermore, it produces rechargeable batteries, solar panels, handset components, and assembly services. BYD also develops sky monorails for Chinese cities, so it has a broad variety of revenue streams. Currently, BYD is operating mainly in China, which is no surprise since China is by far the biggest EV market in the world with 53% of all global sales. The Chinese government extended its subsidies for the purchase of EV cars for another 2 years, but with a 10% reduction this year and another 20% reduction next year, followed by 30% reduction in 2022. Furthermore, only cars which are priced under 300,000 yuan will benefit from the subsidies. Luxury cars priced above are excluded from the subsidies. This is great for BYD since all its cars are selling below this threshold. China wants to increase the market share of EV cars from currently 5% to 20% in 2025, so they are pushing EV adoption with different incentives and schemes. Last month, BYD said it wants to enter the European EV market this year, which is a smart idea in my opinion. The European Union increased its EV sales year over year by 44% in 2019. Furthermore, most European countries increased their subsidies for their citizens to incentivize them to buy EV cars, and BYD can profit from it from the beginning. Let's have a look at some of BYD's EV cars and how they are priced. We can see that BYD has a very broad portfolio of EV cars which are ranging from 89,900 yuan for the E2 up to 290,000 yuan for the most expensive sedan, the Han model. So BYD is profiting immensely from the current subsidies at the moment. This is also reflected in the stock price currently. BYD declined from a high of $10.52 in 2017 to a low of approximately $4.80 in December 2019. After the government announced that they would keep subsidies until 2022, the price of BYD rebounded sharply to now $7.77. BYD is trying to break out through some major resistance, but the volume looks quite low to me, so we have to monitor if the breakout is real or a fake out. If we look at the fundamentals of BYD, we can see that the revenue increased from approximately 100 billion RMB in 2016 to around 122 billion RMB in 2019, which would be around 17.3 billion US dollar. Net income decreased from 4.84 billion RMB to 1.35 billion in 2019. This is accompanied by a decreasing net margin from 5% in 2016 to 1% in 2019. We can see that last year was a tough year for BYD, but the company is not alone. Last year, the whole global car industry and especially the Chinese one took a big hit. The current ratio is almost 1, which says that the current assets are almost equal to the current liabilities and that the company has sufficient liquidity for another year without needing to raise further capital. Overall, BYD seems to have a solid balance sheet in my opinion, and investors shouldn't be worried about dilution as of now. Compared to many other EV startups, it is profitable and an already established player with much lower risk. Here are some metrics to determine whether the company is undervalued currently or not. The market cap is currently at around 24.9 billion US dollars. The current PE ratio is 107.03, which is significantly higher than the 5-year high of 69.82. The 5-year low was at around 19.51. The price to sales ratio is at around 1.42, which is alright if you consider that Tesla has a price to sales ratio of above 7 currently. The price to book value is at around 2.6, which is higher than most of the ICE manufacturers that are trading below their big book value. Overall, I think BYD is still reasonably priced for its growth potential. If they would sell only cars, I think the price would be too high, but if you consider the battery segment, the current price seems fair to me to buy and hold for the long run. If BYD can grow by 15% year over year in the next 10 years, when the EV market really starts to pick up and keep their net margin by 4%, you would get approximately 68 billion US dollar in revenue and 2.7 billion in net income. If you take a conservative PE multiple of 15 in 10 years time for BYD, you would get a price target of $14.95 in 10 years. If BYD grows more than 15%, buys its own shares back, or the market is pricing it with a higher PE multiple, the price could be much higher. But does BYD have a moat which is giving them an edge over their competitors? In my opinion, there are a couple of things that will benefit BYD in the EV market. Number one is that they are producing their own batteries, which reduce their costs significantly. Batteries are the heart of an EV car, and producing good batteries will not only reduce their cost but also provide BYD with another big revenue stream in the future. The more EV cars are produced globally, the more batteries are needed. Only recently BYD made some major improvements in their battery technology with their new Blade battery going into mass production. According to BYD, their Blade batteries are much safer than other batteries and provide a higher range. As of now, BYD did not have big customers for the EV batteries but used them mainly for their own cars. But it seems like their Blade battery made an impression since BYD managed to get a contract to supply Ford with their batteries, which is huge in my opinion. The more they improve their batteries, the more customers they will get when more and more companies start to produce EV cars. Only a very handful of these companies will produce their own batteries. Furthermore, it is not only the batteries BYD is producing for themselves, it is mainly all parts including IGBTs, which are the semiconductors of an EV and the second most expensive part of the car. This vertical integration strategy will help them to increase their profitability over time, in my opinion. The second advantage BYD has is its experience in the EV space. BYD was one of the first companies to launch the EV car back in 2008, so they already know the problems of producing such cars. But let's hear what Warren Buffett has to say about BYD's moat.
Warren, we got a couple of viewer questions, actually several of them, but I want to bring two up right now about BYD, since Carl mentioned this in his introduction to that question. Ray from Westminster, Maryland writes in. He says, everyone seems to be aware of your investment in BYD. That's the Chinese electric car company. The stock's deteriorated of late, and I can't seem to get a handle on the firm's profitability. Are they trying to compete on pricing only, or does their battery technology give them a clear advantage?
Well, the battery technology, if it works out like they hope it will give them a clear advantage. But battery technology is a evolving and tough game, and my partner Charlie particularly thinks that we've got the right fellow to make the breakthroughs in that area. But it isn't like you get it tomorrow or the next day. And you know, there are a lot of smart people working on battery technology, and you know, in the end, what I hope is the world gets a great answer on it very quickly. And if it says made in Japan, made in China, made in the United States, the important thing for humanity is that we get great battery technology. Now, like I say, Wang Changfu is an amazing guy. I'm impressed with him.
The gentleman who runs
BYD,
right.
and my friend Charlie, who knows a lot more about batteries than I do, thinks that this guy is the second coming, more or less. So we'll see what happens on that. It's not easy. I mean, when you're dealing with batteries, you know, the weight, the cost, there are plenty of problems involved. But I will bet significant progress is made by BYD, but there may be more significant progress made by somebody else in the next few years.
Until now, I haven't bought into BYD yet, but I will consider buying my first position when the price drops back to the $5 range. Although I see a lot of potential and growth in the company and a much safer play than NIO, for example, I think the global recession we are in will hurt car companies and other cyclical industries in general and reduce profits even further, which will ultimately lead to lower stock prices. Patience is the key in my opinion. It is just important to analyze good companies and the potential at the moment and put them on your watch list and buy when the price is a bargain. If you like this video, hit the like button to support the channel and subscribe for more videos like that. Bye guys and see you in the next one.